discuss today was the NFT taxation. There's been quite a lot of questions around that. A lot of answers have been provided, especially for the US market. I know that a lot of people are coming from various different points or places around the world. So, taking into account that every jurisdiction actually has its own tax laws and tax events, and might be considering or interpreting these rules completely differently from the US. These are always going to be open questions, and to some extent, I kind of have a feeling that the ICO rush or the ICO craze that we've seen in 2017 is sort of repeating, at least to some extent. A lot of people are still curious how, for example, the gains that they got from the ISO sales are going to be taxed or have been taxed, and they haven't complied fully yet. And here it's pretty much the same. Everybody's now asking whether they should be putting the VAT on, whether they should be reporting their gains, the profits that they're getting from selling their NFTs. A lot of people are actually asking whether there's any taxes that they should be aware of whenever they buy the NFTs or whenever they exchange them for different cryptocurrencies, be it the fungible ones or the non-fungible ones. So, knowing that we're also building an NFT platform, we do kind of want to provide as many answers as possible to our users and craft beautiful, frequently asked questions. And for those reasons, we've been inviting a couple of people to join us today for the discussion. So I'm just going to be reading out loud the tweet post that we've done. So one of the people that we've invited was Jordan Bass from basslaw.io. Another one is Joni Pirovich, and I apologize if I haven't really been pronouncing that name correctly. And then the third one is Shehan. Again, apologies if the name hasn't been pronounced correctly. I hope that you're with us on the call already and that you are going to be providing us with your own introduction. Very much welcome to join as a speaker, not just as a listener if you haven't just yet. And all of these three people have been identified as tax experts in this domain, not necessarily only for the NFTs, but most definitely for the crypto space overall. So that's one thing. If these people are already with us as speakers, which I'm not sure, I very much invite you to unmute yourself and tell us something a little bit about you, what brought you into the NFT space or what brought you in the crypto space, for how long have you been here with us, and something that you would like to share with us before we dive into the questions. I'm a legal officer at DoinGud, and I will definitely be diving into the tax questions more often, possibly into more details as well.
Great. All right. Well, I'll go first. So my name is Jordan Bass from Taxing Cryptocurrency and from Bass Law. I got into crypto and was very, very involved kind of early on, 2015, 2016, throughout the end of my undergraduate college career. I was sitting behind a kid in class, and he was on some sort of web page where looked like he was trading digital assets. I didn't really know what he was doing, but I was interested. So I kind of got a little involved myself, started utilizing the free internet that we would get in our dorm room or in our college room that we were staying in, and mining a little bit of crypto, and just really interested in how that would impact me from a tax perspective, given that I had an accounting background, knowing I was going to get my CPA license and figuring that it was going to become an issue for many, many people, not just in the US, of course, but throughout the world. And so what that led me to do was eventually, I worked at one of those accounting firms, one of the big four accounting firms, but I knew I wanted to have my own business. So I started a CPA firm where we specialize in digital assets. Now that covers everything, not just, ERC20 tokens and BTC and other blockchains, but now, of course, NFTs on, an ERC 721 token. And we have a lot of clients that come to us trying to figure out what the tax ramifications of their underlying activity is. And it's really, really fun to be able to be creative and try to figure out what the impacts of what they're doing on chain has to be reflected on a tax return. So we've been doing that since 2017, and we've seen a lot of things change, obviously, throughout the time from 2017 till today in 2021. And then finished law school, opened up a law firm that also specializes in digital assets. That could be corporate structuring, that could be asset protection. But ultimately, what it comes down to is helping individuals and entities figure out where they stand from a tax perspective, from a regulatory perspective on the tax side, so they don't run into any trouble or any issues, and we can maintain compliance with all the rules and regulations that we have to date, even though, as I'm sure Joni will mention, there is a lot of gray area in this space.
Great, thank you so much. Joni, you want to go next?
Yeah, thank you, Anja, and great introduction, Jordan. Exactly right. I am based in Australia, a Melbourne-based tax lawyer by trade, but have been working in blockchain and digital assets for the last 5 or 6 years now. And so naturally, my legal practice has expanded across financial services, even some litigation on the Ethereum Classic hard fork. More and more so the IP issues as NFTs proliferate, and the commercial day-to-day factors. So I act for a couple of the gaming NFT projects, including DAOs, and even traditional gaming agencies are wanting to start discussions on how they can use blockchain and think about digital assets, or at least plug into it. So the tax, and I also act for a number of individuals who hold and are acquiring these things and designing and launching these things on various NFT marketplaces. So the tax treatment on the individual side is also something that I've been involved with quite a bit now. And in Australia, we have a 30 June tax year end. So our Commissioner of Tax has only put out a very, very minimal amount of guidance on NFTs. And I expect that we may get some more guidance in a year's time, I hope. So I'll leave that there, and then we can drill into the detail after all introductions are finished.
Thank you so much, Joni. Do we have anyone else as a speaker as well? Andrew, do you want to introduce yourself as well, or?
Yeah, sure.
Yeah,
so,
cool.
Yeah, thanks, Anja. So I'm Andrew. I'm one of the co-founders of DoinGud. I actually am a CPA myself. I was a double major in finance and accounting, undergraduate studies, and kind of pursued it as the kind of a basis, as everyone speaks as accounting as the kind of language of business, but didn't go the public accounting route, but rather the corporate route initially, in a finance track and consulting track. So I eventually taking another step from there to do a master's focusing on entrepreneurship, and that's what led me here to DoinGud, overseeing the finance and operations side of the organization. And I like to say I know enough to be dangerous, to follow the tax side, but can't pretend to be the expert that Joni and Jordan here are. So I'm also interested to learn a lot of what you guys are seeing and closer to this area. Thanks for joining us.
Pretty awesome. Thank you so much for the introductions. All right, so I'm gonna kick it off with the very first question, and possibly a very dumb one, but I'm just going to take the actually start what it is that a CPA does. Anybody?
I'll take that one. So,
Thanks.
of course, it depends. So, there's like Andrew was saying, you can go the public accounting route and you can go the audit route, right? Assuring that things that are being reported on entities' financial statements are actually what they are, right? And corroborating that data. That's like attestation, right? That would be public accounting, mostly from the assurance side. CPAs also practice tax. Some people do both. Some people have licenses that allow them to certify financial statements, and then they also, of course, can file tax returns and help people from a tax planning and structuring perspective. Some CPAs that get their CPA license also maybe go the route that Andrew was mentioning, instead of going the public accounting route, going the finance route, and leveraging their pure accounting background and understanding of financial statements to help from an investing standpoint, possibly, or for internal accounting for entities. But there's a plethora of things that CPAs do and things that fit the job description. What tax accountants do, so you don't technically have to be a CPA to be a tax accountant, but what tax accountants do when we're dealing with the area of tax is not necessarily the same as the financial accounting perspective, where you have different rules and regulations, GAAP accounting standards, international reporting requirement standards. You have to abide by certain regulatory frameworks, and there's certain things that you have to do when you certify financial statements. In the tax accounting world, we're really abiding by something called the tax code, at least in the US. So we have the Internal Revenue Code. It's codified. It's an area of law, actually. And when you go to law school, like I did, you can actually study tax law. I didn't mention I'm actually finishing a tax LLM program at NYU, where we're studying more in depth the tax code. So you can see there's so many areas of the tax law. And that's not necessarily what CPAs do, but that's what I do as a CPA, and that's what a lot of other tax accountants do, is maneuver around the tax code, see how things can be treated and recognized from a tax perspective based on things that have been codified into law by the government. And that's also something that's been a high area of discussion right now in the crypto space with the infrastructure bill in the US, where they have a definition of what a broker is, and that's going to directly impact the IRS and tax reporting requirements. Those are some things that CPAs do, making sure that entities are in good standing, not just from a financial accounting perspective, of course, but also a tax reporting and compliance perspective. So tons of different things, of course. It's a great question. CPAs do a lot of different things, just like lawyers do different things in different areas of law. But ultimately, when it comes to crypto, there's two things that come into play. One is valuation of assets and reflecting those on financials. So that would be, the first sort of example that I mentioned. And then two, which is usually the most sought after information that I receive, is how does this impact me from a tax perspective as an individual investor, an institutional investor, or as someone that, in this case, creates NFTs and sells them in the open market.
Oh, that was incredible. Thank you so much for introducing us to your expertise. And yeah, absolutely. I've been hearing about the regulatory issues, especially in the US, and the new bills and how these might be changing. You definitely are going to be busy, and we for sure know where we're going to be looking for the expertise. Now, looking into the room that we have here on Twitter Space, I'm kind of recognizing that we might not all have the legal degree or extensive knowledge in the accountancy, for example, or tax application. So I just kind of want to understand better and hopefully share that understanding or learnings with everybody in the room with regard to how soon should one be looking for the tax advice or the accountancy advice. We are all basically looking into the NFT markets. We're all purchasing some, selling some, perhaps having the collectibles. But yet it's almost as if some unwritten rule that if you just hold those assets in the crypto, no one's gonna know. So unless you actually put those assets or just exchange the assets and then put the profits onto your bank account, then the IRS or any other tax authority might never actually learn about these profits. So I just really want to be very open here and ask you directly, how soon should someone be looking for the advice, and how soon should they be, considering about the tax reports and getting a proper accountancy and be compliant with all the standards and the codes that you're putting together?
I can tackle this one first if you like, Jordan. So I think there's a couple of trigger points, and I will just say that these are general comments only. I am a tax lawyer, but not your tax lawyer, so please do go and get your own advice. But most individuals would probably start off just experimenting, making NFTs or acquiring them as a bit of a hobby, but perhaps actually maybe more of an investment. And if you're on that side of hobby or investment, that matters from an Australian perspective at least, because as soon as your intention changes to one that you're acting as if you are running a business, or if in one instance, and it's significant enough, you've got a profit-making intention. So, let's just say you bought an NFT for less than $500, but hey, the market's up and it could be worth a couple of thousand or tens of thousands, and you don't just list it on an NFT marketplace. You go and do a marketing campaign. Something like that additional effort of a marketing campaign or advertising, that could tip you into the bucket of a profit-making scheme. And that's relevant from an Australian tax perspective because it might take you away from what we call capital account. So holding something as an investment, and there are tax concessions for long held capital assets if you hold them for at least 12 months. It could take it away from capital account and tip you into a revenue account bucket, and you don't get the tax concessions that are available there. And that's a really key trigger point, especially if you're using one wallet for a number of things. Because if you're holding ETH, Bitcoin, name your coin for investment purposes, and some of your NFTs or one of your NFTs tips over into that revenue bucket, then trying to prove to the tax commissioner that one tainted or one revenue asset doesn't taint the whole of all of the other capital assets, it can be a hard exercise. And we haven't been through any reviews or audits with the Commissioner of Taxation yet, so we're not exactly sure what the line is, or how much you can deviate from what that line might be to try and prove capital account treatment or intention. But these are the things more so as hygiene that you can be mindful of. And one of the best things that you can do if you can't afford proper tax advice, and this space does get very complex very quickly. So it's not just really a matter of going to your tax accountant or tax lawyer with your bucket of receipts at the end of tax time, or your Cointracker or coin tracking that has tracked all of your transactions. A lot of these things require a substantial amount of thought, and it does go back to your individual facts and circumstances to determine how the tax law applies to you. So just keeping accurate and real-time records at the time you're doing something, what your intention was, the date of the transaction, your Australian or US dollar values of those transactions when you're making them, as well as who the counterparties are. If you don't know them, then you could simply say, I'm listing it on OpenSea or DoinGud, for example. And also just to say this is a realization of a capital asset, if that is merely what it is. And all of those accurate, up-to-date records will be the best evidence in proving what your intention was, because when you come to the tax accountant at the end of the year or many months after the end of the year, and you've got to try and recollect, in all of my cryptocurrency clients, that is the hardest thing that they find, just trying to remember what they did, what the block ledger is showing, or what their transaction reports are showing. And that exercise for the taxpayers, I feel for them. I'm in my own world of pain, from early on when I wasn't keeping up-to-date records. So try to do that. And then the other tough thing is, you've got artists and gamers who would traditionally interact with, the art world or gaming products. And there wouldn't really be a question of whether they're doing that as a hobby or in the nature of a business. But now that NFTs are allowing, actual ownership of in-game assets and transferability of those in-game assets, and even with artists, you can display it in worlds like Decentraland, so that there's an active market for you drawing something and displaying it. in those sorts of avenues. That is, again, something where if you've traditionally thought of yourself as just a hobbyist gamer, but you're doing it a couple of hours a day, or regularly a couple of hours or more a week, this is some of the indicia that you could be in business as well. So again, it tips you onto revenue account, no tax concessions. But if you do speak to a tax accountant or tax lawyer upfront and early, you may be able to restructure so that you're not operating as a sole trader. You transfer your assets to a company, and in the Australian case, at least, there can be advantages of capping your profits at the company tax rate rather than being exposed to the individual and much higher tax rates. But a company in Australia doesn't allow flow through access to those capital account CGT concessions. So you want to make sure if those other capital assets, capital digital assets, are in a particular wallet, that you also do some wallet hygiene to try and split that out and only have the company with a wallet that holds the business assets, and your individual assets are kept separate. So those are a couple of the high level and timing considerations. I think I'll hand over to Jordan to chat from a US perspective.
Yeah, I mean, the tax rules and the treatment of a lot of these line items from a tax perspective sound very, very similar. I'm not going to pretend that I'm an expert in the tax authorities over there, but to answer one of the questions that was asked, to how would, let's say, a government or a taxing authority be able to determine that somebody was buying and selling and accessing, let's say, the NFT space, right, and purchasing goods or purchasing NFTs, buying NFTs. It would all be associated with a certain wallet address, and in theory, that wallet address would not be tied to someone's identity. So maybe they don't have to report that activity, right? That's what they say. But what I always tell them is, at least from the US perspective, you have to be aware that the IRS actually does have a lot of tools at their disposal, not looking at how it's taxed, what it's taxed, what's the actual gain, what's the tax rate, but just purely knowing whether or not somebody actually bought and or sold, whether it's a token or an NFT, it doesn't matter. They have tools at their disposal, and the way that they do it is really by looking at the fiat on ramps and off ramps. So if somebody bought, let's say, Ethereum on Coinbase or Kraken or Gemini or even BlockFi, one of these U.S. regulated exchanges that reports to the Department of Treasury, and then ultimately, which would go possibly to the IRS, depending on what happens with this infrastructure bill. They get that data no matter what. Otherwise, as of now, they kind of have to subpoena those records. The IRS would have the ability to see a certain account sent funds from their Coinbase account to an unhosted wallet, like a MetaMask wallet that would be, let's say, an ERC20 wallet, and there's funds flowing to there. Then from there, they can track and trace all of that activity on chain. And then ultimately, in order to off ramp, that individual is going to have to send funds to another centralized exchange to get the fiat out of the market. So in theory, if you never do that, if you're a crypto native person and you bought your assets offline, maybe in an OTC deal or with cash, okay, then maybe that's not the answer for you. And again, I would never advise for somebody to do that. But what I'm saying is, people shouldn't be so naive to think that the IRS won't be able to see that data if they already can't at this current moment in time. Maybe they personally, that entity, that governing body, doesn't have the ability to do that. But there are tons of firms out there like, CipherTrace or Chainalysis, I think just raised $100 million in a like the multi-billion-dollar valuation, where that's literally what they do. They trace illicit funds on chain, and maybe they get contracted out to do that. Maybe they do it for their own internal reporting purposes. But there is an ability to track and trace this activity on chain, when you know who the individual is, because as I'm sure Joni could attest to, when we have clients come to us and they say, hey, I have these exchanges that I operated on. I know that there's these wallets that I was either purchasing NFTs with or providing liquidity on, Uniswap or SushiSwap with. I don't know if these are all of them. We might have to go through that tedious process of sifting through block explorers and trying to parse out different wallet addresses that may be tied to that individual. And we can do that. It's more of a manual process. There are there are firms that can do that at a much larger scale than somebody like myself or Joni, even though I do that for many, many clients. So to answer the question about can they find out, will they know? Yeah, they will. It's always safer to just disclose everything. You want to pay tax on the money that you've generated. Maybe you want to find an efficient way to do that, but you definitely want to pay your tax. But ultimately, what it comes down to is you want to be on top of it before it becomes an issue, just like Joni was saying, because when you go back in time and you don't know what that transaction was for, and you don't know what this transaction was for, and some people we have to go back, historically 2015, 2016, maybe 2017, where there's exchanges that they used that are no longer in existence, where there are exchanges that they use that they're geographically restricted from using again, and they maybe don't have all of the data. So there are black holes in the data. You want to definitely reach out to a tax professional early on if you plan for this to be part of your investment portfolio, like a substantial part, or if you expect this to be something that you're going to be doing on a day-to-day basis. And from an NFT perspective, being a creator or purchasing and collecting NFTs, and this is going to be a passion of yours that you're going to be engaging in every day, which again, like Joni mentioned, we have similar rules for hobby and trades. So ordinary businesses and hobbies, they get different tax treatments. But ultimately, you want to make sure you're on top of this so it doesn't become an issue, because once it becomes an issue, it's very, very difficult, even for professionals in the space, to unwind that issue and get to the point where now it's smooth sailing from here on out.
Yeah, if I could just add that, at least from an Australian perspective, the obligation is on the taxpayer to keep good records and to self-assess their tax position. But where there is some uncertainty, that they at least document why their tax position is reasonably arguable. And there's some guidance that the tax commissioner sets out on what you have to demonstrate in order for something to be reasonably arguable. But if there isn't enough information to properly assess the tax position, our tax commissioner has the powers to deem an assessment. And this can get into dangerous territory, because in reviews and audits that I've been involved with in the past, not related to digital assets, you can either be put in the good bucket or the bad bucket. And those uncooperative taxpayers that haven't kept good records, but also are not helpful to try and understand the true state of the situation, they get put in the bad bucket. And if the commissioner goes through and does the blockchain analysis, traces through the forensic of maybe the initial wallet address and connected wallet addresses, and does their own analytics of what the gains and losses might be, then that tax position that the tax commissioner comes up with could be far and beyond much greater than what the actual position is if you went and did it properly. And so that can be a really hard stick that is pulled out. And I expect that there will be some cases that our tax commissioner does adopt that approach in the next few years, that you are incentivized to go and do the hard work so that you can defend perhaps a lower tax position than what the tax commissioner is brought in front of you. And obviously, once that assessment is made at the higher level, you are liable to pay that tax bill. If you cannot, you may be made bankrupt, and that can have flow-on impacts for whether you want to be entrepreneurial and directors of businesses and so forth. So I just caution everybody that that the onus is, at least from an Australian perspective, on you to be keeping that data and collecting your tax position, and you might want to be doing that at least to defend a higher assessment if and when it does come.
Yeah, I agree that it's a bit naive to think that the governments won't find out about activity, and they're going to come after their tax money always. And it's kind of opposite of the fact that the blockchain is entirely transparent. Like that's part of the point, right? It's the public ledger that can be traced. I know, like Jordan said, there's tools that organizations privately are developing that enable that at a larger scale, and it's a bit naive to think that the governments won't have that if they don't already. So I think another thing that's important to note, and why it's important to be on top of it from the front end, is that you don't want to be hit with an unsuspecting tax bill when the time comes too. If you're kind of pushing it aside, thinking it's not going to matter, and then the day comes where you realize, oh wait, I've been doing all this. Is there a tax impact? And you don't know what it might be. You might not be prepared for what that bill might look like. So another reason to be on the front end of it.
Yeah, no, I think Anja mentioned she might break up after the half-hour mark. So I actually haven't done a Twitter event before, but if there's any questions in the chat, then I think Jordan and I are both happy to answer some questions. But before we get into that, there are also, some other exemptions for personal use assets and collectibles. And the key threshold there for a personal use asset is $10,000. If you acquire something for less than $10,000 and keep it or use it mainly for your personal use and enjoyment, then it may be any capital gains on your disposal can be completely exempt. But again, this is a hard line to draw because you displaying your artwork in your Decentraland house, question whether that's you using it for your personal use or enjoyment, or it has an incidental or more of a purpose that you're marketing it, for a potential very profitable sale. And so, again, that's why it's important for you to at least document your intention and get some tax advice when you do come to dispose of it. And then the collectible side of things has a limit for, and a clear definition, which does include artworks. That's a limit of $500 that something needs to be purchased under. And if you're pooling your resources to just say that each of you put $500 in for something that's worth $2,000 or more, then that won't be a collectible because the total value of the collectible needs to be 500 or less. So for any gain to be exempt when you do dispose of it. So again, documenting that intention as between collecting it for your own personal use and enjoyment versus investment and to speculate on any potential gain, that's a hard line to draw. So open to questions if anyone has them.
Yeah. Oh, I would actually like to just touch on the collectible thing in the U.S. at least. I actually was having this discussion this morning with another tax attorney, so I figured I'd bring it to your attention for everyone because, as Joni was mentioning, there is a difference between a capital asset and a collectible, at least in the U.S. Different tax rates, and what we deem, if you look at the pure read, and I know this may be a little nuanced and boring, but I would like to explain it a little bit because I think it is a little important. When you look at the treatment of what a collectible is in the tax code, it's in a section called 408M2. You don't have to worry about that, but what you have to know is that they define a collectible as any work of art, any rug or antique, any metal or gem, any stamp or coin, any alcoholic beverage, which I know is funny as a collectible, or the catch-all, which is any other tangible being the key word, personal property specified by the secretary for purposes of that section. So if you read it by the plain text, you can maybe make the argument that collectibles are only for tangible assets. There's no intangible reading in there. Maybe the catch-all would be any work of art, but maybe some NFTs aren't work of art. So maybe they're not collectibles. And therefore, if you could successfully, I'm not saying that this is an argument that I would make, I'm saying it's gray area. And if you successfully make that argument and it's a capital asset in your hands, it's a lower long-term capital gain rate than as a collectible. Now, I think everyone can kind of agree that we as a space, as a crypto community, have kind of agreed, right, that these assets are collectibles, they're digital collectibles, and maybe that's the proper tax treatment for it. That's the treatment that we've been taking as a firm for most of the last year and a half when people have sold NFTs. But it's something to illuminate how there's so much nuance in what we're talking about, and there's no laws, at least in the US, that have been crafted with crypto, with digital assets, with intangible art in mind. So there's going to be a lot of changes. Things that we're talking about today, next week might be outdated. Maybe not from a tax perspective, but at least from a regulatory perspective, or from the way the IRS views this asset or that asset. Things are changing every day. So that's why, and I think Joni would agree, that's why it's important to make sure that you're on top of this if you want to make this a material part of your investment portfolio, or if you're just loving NFTs and you really, really enjoy the camaraderie, the brands that you're investing in effectively, the projects that you're investing in, the art that you're investing in, and you have an attachment to it, you want to make sure that that attachment that you have to that piece of art doesn't kill you from a tax perspective down the line. But that's just an example of how things could change. We don't have definitive guidance. There is a little bit of gray area. The way it's treated from an investor is definitely more gray area, in my opinion, than the way it's treated from someone that's going to be creating an NFT and then selling it either on the open market, or having a drop where people pay a certain amount of Ethereum for that token, and it's kind of random, or from that for that NFT, and the attributes are sort of randomized. But at the end of the day, if anyone has any questions, I just want everyone to understand that this is a fast-moving space, and the regulations and the tax treatments and the code are not keeping up with that movement. So things will change. Things that we're talking about today may not be the right treatment, a week, a month, 6 months, a year from now. And I just want everyone to make sure that they're aware of that before we lead into any sort of questions that you may have.
Yeah, I think we lost Anja.
Yeah.
Yeah, I'm back.
Okay. Oh, there you
are. I mean, if anyone has questions and they maybe want to, ask them in private or so, anyone, you can always direct message us if you'd like, if there's like generic questions. But like you guys were saying, if anyone has any questions here, don't hesitate. Have a little bit of extra time here to chat, for me at least.
Yeah, feel free to request to speak. Just note that you'll have to be on your phone in order to speak as a speaker here. So if you have a question, feel free to switch over to your phone if you need to, and just request that.
You definitely did open a lot of questions on my side. There's one big one that has been bothering me for quite a while. Thinking of the NFTs and how, for example, every artwork, the creative work that we are pretty much putting together and then attaching to the NFT is being composed as a metadata. It sort of looks to me as if, if the tax is applied to a purchase, sell agreement, for example, of that specific creative artwork, does that suggest that the NFT as a whole token, as the new cryptocurrency in space, or just the tokenization of it, presents more or less something like an invoice or a certificate, and is not necessarily being taxed because it's a certificate, but rather the bottom line legal agreement is the one, and the transaction is the one that suggests which tax is going to be applied and how this whole transaction, for example, is going to be taxed, and then on top of that, who are the parties involved and how they present themselves through which legal entities, through which jurisdictions, all these tiny little things are then being taken into account. I just kind of want to double check what your understanding of the NFTs here actually is, because the NFT, to me, it does not necessarily resemble or suggest that it needs to be considered as the artwork directly, but rather something that might represent the artwork being attached as a metadata. Do you guys understand that the same way, or do you see it a bit differently? I totally understand that the tax is going to evolve here, at least the law. And for those reasons, there's always going to be new guidelines, new opinions from the the regulators and the authority overall. But it really is a big question. Is the NFT really the artwork that we're attaching through the IPFS, and then linking through hashes to the NFT tokens, or is it something different?
Jordan, I can jump in first if you like.
Sure.
So it goes to the heart of some questions here, and we've been having this debate for a long time, whether smart contract code, and NFT code is enough to demonstrate a legally binding contract so that it can be a smart legal contract. That's not always the case, and actually often not the case in, I suppose, NFT transactions, but transactions with decentralized applications anyway, because we're still not clear on whether there is a counterparty. So whether a smart contract operating autonomously is a legal person that we can contract with and that can make an offer, or whether we look through to the governance model of the system, I suppose, and if that's governance token holders, or if it actually is a company or a centralized party, do we attribute the counterparty to that person or persons that we're dealing with? So that's one of the key questions, trying to understand the structure that you're engaging with or transacting with, if there is a clear counterparty, and it may be that you're just interacting with a marketplace. So that may be simpler, and the contractual terms are then set out in the platform's terms and conditions. When you're interacting with a DApp, you won't have necessarily you may not have terms and conditions at all, or you may not have comprehensive enough terms and conditions that help you understand where your legal or tax position is. A lot of them are adopting the position to say, individual or person, you are responsible for determining whether you are legally eligible to participate or to acquire this, digital asset, and for determining your own tax consequences, and if your jurisdiction actually prohibits you and can criminally enforce action against you, because there are some jurisdictions taking an aggressive stance on this. Trying not to muddy the waters too much, but when you're talking about or breaking down what artworks are in an NFT, whether they're original, whether they represent a license to reproduce, and especially where that NFT is being transacted cross-border, we can trigger a royalty withholding tax regime. And this is if the payment for the NFT or part of it constitutes some sort of payment for a license, or that fits within the definition of a royalty, then you have to look at where the counterparty is, and like I've said, that can be difficult. If there is a clear jurisdiction, then you have to look at what royalty withholding tax rates might apply, and then pay them, because we don't have smart contracts being written to automatically withhold the royalty withholding tax amount and send it to the relevant tax authority, which is already infrastructure that is in place with agreements between entities that do cross-border IP and licensing transactions. That level of sophistication hasn't made its way into smart contract designs yet, nor in the NFT marketplace platforms. So that gets really complex really quickly, and it also can involve some analysis of double tax agreements. And I would only get into that kind of analysis if, a sophisticated artist with, substantial sales, and it wasn't just a clear-cut sale. Maybe there was a licensing arrangement, because there's an ongoing retaining of IP. Again, the smart contract code doesn't typically have the same clauses that we see in IP license agreements, but maybe that is getting more sophisticated as, the likes of Dapper Labs and sporting agencies are not just dipping their toe in the water, but getting more involved. So, as Jordan said, it's an evolving space. I think that the complexity will have to be dealt with by, the substantial players that are earning a lot of money in this, because individuals just simply won't be able to afford to get advice. At least, in my experience, there's a few whales that might pay for that kind of advice, but for the individuals, it's just too far beyond them to go into that level of detail.
Thank you so much, Joni, for that. Taxes are quite complicated. I hope that this conversation gives enough confidence to all the people listening to the conversation to get a tax advisor ASAP, or at least an accountant, and to kind of resolve their situation with the NFTs purchases, the profits that they are obtaining, and possibly, all the relationships that we're going to be creating on all various different platforms. Now, one very specific relationship that DoinGud is going to be forming is also not just the royalties provided to creators, but the donations. And I just want to tap into that, gather some of your thoughts, if you have any, on the write-offs of the taxes for whomever makes that donation. Now, we had a lot of back and forth conversations with some people with regards to figuring out who it is that really makes a donation, because, dealing with blockchain transactions, everything is basically happening in a very automized way, meaning that the smart contract kind of takes care of how the transaction is going to be ordered and who's going to be getting the profits or who's going to be getting donations. Everything's basically happening at once. And for these reasons, it's been quite hard for us to figure out who might be the ones making a donation or in control of that transaction. But the biggest question here, which might be much more suitable for you, is what do you think about the write-offs? Is it something that applies if, for example, with the purchase of an NFT, somebody makes a donation to a social impact organization, or is that something that is completely out of scope?
Well, from the U.S. perspective, definitely can be done. Crypto donations, NFT donations, any sort of charitable. What would be viewed, and it might be a little different for Joni, but in the U.S., any charitable donation that's a quote-unquote non-cash charitable contribution, in theory, what you have to do, if it's over the amount of $5,000 of USD, if that's the valuation, then usually what you want to do is two things. And if this isn't answering your question, I apologize, but you want to get a written acknowledgement from the charitable organization that you're donating the funds to, right? And then you also want to have adequate records to make sure that you have some sort of valuation, some sort of ability to determine what the value was at the time that you made that donation to that organization. When it comes to determining who's actually donating the NFT or who's actually donating the digital asset, we kind of have this issue a lot, at least from the crypto side of things, not necessarily the NFT side of things, where you have an individual that maybe has an entity, and that entity they use to make investments, and they are custodying crypto in that entity, but for some reason they have an external wallet, an unhosted wallet that they use, and it's sent funds back and forth to their personal account, and they send the crypto donation from that wallet. What you would have to do, you could make the assumption and you could take the position that it's the entity that's donating. This is just a good example of a person A and person B, one being an individual, one being an entity. You could make the assumption and take the position that the entity is the one that's actually contributed that that crypto asset, that digital asset, for their charitable purpose, but the individual was the actual person that in fact sent the funds, that sent the digital asset. So ultimately, what I've seen is that it comes down to who had dominion and control over the asset to actually make the charitable contribution. It's most definitely has the ability to be deducted. I would say that there's no, like I said, how we've been talking about for the last hour or so, there's no definitive guidance on NFTs per se, but we did get an update in the IRS's FAQs on virtual currency transactions on how do you calculate your charitable contribution deduction when you donate virtual currency. And this is, again, a little different. Maybe you classify it as something else. Maybe collectible is not the same as this capital asset property. But ultimately, if we have something to refer back to and say, okay, we're going to take this position, your charitable contribution deduction is generally equal to, right, the fair market value of the digital asset at the time of the donation. So in theory, same thing would go for an NFT. And if there's like an NFT on the open market, you might not know exactly what that fair market value is because it's up to the market to determine that. But there may be, a certain collection that has a specific floor price, or maybe you take an average price from the collection that has these specific attributes that maybe make it a little more valuable than others. There are things that you can kind of do, work smart to figure out what that deduction should be. But at least on my end, what I see often is when you're trying to determine who made the contribution, it's usually ultimately at the end of the day who had the ability to exercise dominion and control of that asset and then subsequently sent it to the, in the US 501c3 organization or the charitable organization that is going to ultimately receive the funds. And if you kind of follow those rules of general practice, you won't necessarily run into the issue of trying to figure out who gets the deduction. Oftentimes there is, people have transfer property to other individuals, and then those individuals make the charitable contribution. There are catch-all provisions in the tax code to avoid people from playing those games. But at the end of the day, whoever is sending in, if it's an org, if it's an individual, whoever is actually executing that transaction and making that charitable contribution, in our opinion and in my opinion, what I've seen in the past is the one that is going to be getting the deduction, making sure they maintain those adequate records, making sure that they have the ability to value that asset at the time that it's contributed. And in the NFT space, it might be a moving average. It might not be a definitive actual value unless it was bought and then subsequently contributed almost immediately thereafter. You could probably make the argument that that would be the fair market value, or that would be the value of the contribution from a fair market value perspective.
These are possibly the most important questions here: the fair market value, and when the taxable event is actually taking place, how something is being evaluated from the tax perspective. If I obtain some profit today, and today is the taxable event that the tax authority looks into, but in half a year those tokens are worth nothing, or in half a year those tokens are worth bajillions of dollars, then possibly the tax authority might actually change their perspective on how much they want to charge me. These are very, very important questions, and I'm definitely looking forward to explore them together with you guys. Thank you so much for the conversation today. I very much enjoyed it. And to sort of reset the room, as they say in Clubhouse usually, again, I'd love to invite all the listeners to request to speak. If you have any open questions, now's the time. You might as well just click on the speakers and follow up with everybody. Shoot a message to them or ask a question directly on Twitter or personally. But yeah, the floor is definitely open for a couple of more minutes. But from my end, I would very much just like to say thank you, and hopefully we'll stay in touch.
Thanks for having me, Anja, and doing good.
Yep. Thank you as well. It's been a pleasure.